know what to do in a situation like that. That's why individual investors often lose money in an event like Katrina. The professionals understand that at times like Katrina, it's not about making money, it's about preserving capital. In the days leading up to the storm, Mark was looking at the big picture, attempting to calculate the impact of the hurricane on the structure of the energy market. The goal was to reduce our risk, to manage our risk first, which is what the vast majority of investors don't understand. Manage your risk first, and you are sure to come back to fight another day. That's the number one priority with something as big as Katrina, or even with something as small as a quarterly earnings report from a company in which you own stock. In summer 2005, with Hurricane Katrina looming, if any trader had a large position in natural gas and the market went against him, he would have been forced to liquidate his position and take a substantial loss. Being forced into a decision is not a winning investment strategy. Nobody has a sustainable track record of profits when they're forced by the market to make a decision. The investors who are successful are those who avoid having their decisions dictated by the market. The best traders make their own decisions and do not allow outside events to force their hand. Hurricane Katrina posed two potential outcomes that worried us. In a hurricane, most people incorrectly assume that the price of oil spikes because of the threat of an impending shortage. That's wrong, though, because the president simply could release oil from the Strategic Petroleum Reserve to satisfy the need for oil. It's not oil that matters, it's gasoline, a byproduct of oil, which is produced in refineries. Refineries are littered throughout the Gulf Coast, and what do refineries need? They need electrical power to run them. They also need to remain dry. So the two worst things that could happen to refineries are that they lose power and they flood. If the hurricane hit, the price of gasoline, heating oil, and natural gas would skyrocket because the pipelines would have to be shut, creating a scarcity of those commodities. In that instance, had an investor been long oil, meaning that investors expected prices to rise, he would have made a great deal of money after the hurricane did its damage in the Gulf. Had the hurricane missed, then the prices of those same commodities would have fallen by a significant margin once that risk was taken out of the market. My title at MBF was Director of Trading. One of my many responsibilities was to manage risk and to make sure that we never bet the firm on a single trade or event. I had 75 proprietary traders putting the firm's money to work, plus junior traders and interns. About 300 team members reported to me in all. I was dubbed the Liquidator because everyone knew that when I showed up on the trading floor, located at the World Financial Center, right on the Hudson River, my job was to get a trader out of a particular position by selling large blocks of a particular asset. This happened frequently, almost always when one of our traders was down a lot of money and just could not pull the trigger to take his losses and preserve his capital. However, my job entailed more than simply selling commodities or securities. My job had a technical side too. Mark entrusted me to see the big picture and to ensure that the firm's risk was properly allocated. The toughest part of my job was taking a trader out of the game. Like a baseball team manager relieving a starting pitcher and taking him off the mound, my job was to take that trader out of the pit. It wasn't always easy, and taking a trader out of the pit often meant tense moments for both of us. Still, I loved my job, and I never forgot how far I had come. I had grown up in Valley Stream, Long Island, a working-class town just a few miles outside of the super-wealthy Five Towns community. As a kid, I needed to hold down 3 paper routes: for Newsday, the Mail Leader, a local paper, and the Daily News in order to have spending money. Now I held a leadership position in one of the great trading firms in the country, a firm that was headed for a potential crisis unless I was able to effectively protect its coffers from overeager traders trying to bet big on an uncertain event. Aside from keeping an eye on what our traders were doing that morning, I needed to understand their mental state. And the mental state of most of our traders leading up to Katrina was lousy, to say the least. Katrina was scheduled to make landfall on August 29th, the Monday morning after what is known among my colleagues as Guilt Week, the week between the end of summer camp and the start of the school year. Guilt Week started on August 22nd that year. This was the week when all of the dads and moms who hadn't spent much time with their children all summer took the week off to be with their families, flocking to the beaches and other kid-friendly destinations. However, Guilt Week was just a